infrastructure like industrial parks for electronic manufacturing clusters for promoting electronic manufacturing, something on R&D to create more innovation, to encourage more innovation in the electronic sector, and also some skill development programs to enhance that whole overall talent pool in the electronic sector, which is aimed at improving the productivity and overall skill set of the employees. So this is something that we expect and we would want the government to really think about.
Well, that's the big voice, as Tamanna said, the poster child of this whole PLI or the EMS field. But one more set of numbers that came out earlier, or rather yesterday, was Supreme Petrochem. The numbers look good on the face of it. Revenues up 28%, operating margins expand, and PAT up 76% at 122 versus 69. The stock took an initial beating because the numbers were below what was estimated, but has recovered a bit because it was still a strong quarter. Mr. Rakesh Nayyar, who is the ED of Supreme Petrochem, joins us right now on the show to talk about the numbers and the outlook ahead. Mr. Nayyar, good having you. Thanks for joining in. Decent quarter. What led to the kind of expansion, about 280 basis points, that we've seen on the operational metrics?
See, one, there's a volume growth. Overall, our total volumes went up by 20%. And last year in the corresponding quarter, if you look at it, we had then also mentioned that there was actually a dip, sudden dip in the styrene prices, which brought down the prices of the end product, and also it had put some pressure on the margins. But then otherwise, this particular quarter has done better than the last year, mainly because of the increased volumes and better demand from the OEM sector as well as the non-OEM sector. Both sectors have done well in this quarter.
So, Mr. Nayyar, this uptick in volumes, is this, I mean, one, what is the business case for this? And two, how sustainable or predictable is this for the remainder of the year?
See, generally the first quarter, that is the last quarter, or the first quarter of the calendar year, and the second quarter of the calendar year, they are the good demand months. Then when the monsoons start, then they become the lean months, and post the festival season, again, there is generally a lean demand of the OEMs and the other products. So automatically the demand for our product also reduces there. So the first quarter, that is the first quarter of the calendar year, and the second quarter of the calendar year, the volumes have done well. And going forward for the year as a whole, the guidance what we gave last time also was that our volumes would grow between 8 to 10% in the current financial year.
Okay. So that volume growth, Mr. Nayyar, what's the, how do I say, what's the difference that they will make for either the EBITDA numbers, or, for example, what could happen on the bottom line? Because as I look at your numbers, standalone basis at least, this must be probably the second best quarter in the last 8 quarters. It is, as you said, a factor of the volume growing as well. Will we see Q3 showing a substantial dip in both volumes and thereby on the EBITDA? And will it recover enough in quarter 4, or will it still be lower than what you've done in quarter 2?
See, it varies from quarter to quarter. And so the third quarter, that is the second quarter of the financial year, is generally the lean month. So it's very difficult to predict that how the OEMs behave in this quarter. And depending upon their sale, depending upon the non-OEM sale, the volumes will either increase or decrease. But then the overall in the year, we know that we will be able to increase our volumes by around 10%.
Okay. Okay, fair call. In which case, let me try and figure out what could happen YOY, sir. I mean, from FY22, if I'm not wrong, your numbers are circa 5,500 crores on the top line. And correct me if I'm wrong here. When does this change? Is there a capacity coming on stream? Are you thinking of any other inorganic moves, if you will? What happens for the, let's say, not just the next 9 months, but maybe the next 18 months?
See, the top line is a function of our raw material cost also. During the year 23-24, financial year 23-24, the raw material prices were down by almost 11% as compared to the year 22-23. Though our volumes grew, in the year 23-24, but then the top line did not grow because the volumes were down by almost, the raw material price was almost down by 11%. Whereas our volumes did grow by 13% odd, but then the raw material prices were down, so end product prices were down. So that is the reason that the top line, you may not see any increase or a substantial increase there, but then the volume growth is there.
Okay, and so are you saying that that's how it's going to remain? You reckon that is the kind of number that you will probably deliver even in FY25 between 5,000 5,500 crores?
No, the raw material prices have marginally gone up, and with the volume increase, if the volume increases and the raw material prices are stable, to the extent of the volume increase, the top line will go up. If the raw material prices are dropping down, so automatically, as I said, the top line is a function of raw material price.
Okay, fair call. Is there a formal guidance that you're laying out, Mr. Nayyar?
I'll lay down a formal guidance as far as the raw material, our volumes are concerned, and which I earlier said would be between 8 to 10% increase during the year.
For the volume, not necessarily otherwise. The reason, sorry, before I wrap up, the reason I was insisting upon this is because when I read a few notes, Mr. Nayyar, they talk about how your EBITDA margins could actually expand in FY25 and 26 from about 9% to about 10% and 11%, and subsequently, their estimates of what your profit numbers could do are fairly high. I was just trying to think if these are outlandish estimates or could these be realistic, because from 346 crores in FY24, the notes presume that you might actually reach a number of 626 crores in FY26.
See, I don't know those estimates, but then we would be completing our mass ABS plant project by the end of this financial year. And also second phase of our EPS expansion would be over by this year. And going forward, they would be adding to our top line as well as our bottom line.
Okay, so, well, okay, on ABS, demand expected to go up to 4 lakh MT, you have a capacity coming in. So I guess that's why the numbers of maybe 600 crores bottom line by FY26. You are saying these are not outlandish. I'm not asking you for a specific number, but these are not outlandish.
See, I really can't comment upon the numbers.
Okay.
But then yes, if I buy on the current prices of ABS at 100% capacity utilization, our phase one of our mass ABS, it will add 1,000 crores, about 1,000 crores to our top line. Similarly, EPS phase two at 100% utilization at current prices would add about 350 odd crores to our top line. So the top line will be a function of volume growth, as well as considering that the raw material prices are stable.
Okay. Well, but we wish you all the best for that, because if you're adding about 1,000 crores on a top line of nearly 5,000 crores, that's a significant uptick out there too. So we wish you all the best for that and more. Thanks so much, Mr. Nayyar, for talking to us.
Thank you. Thank you.
Right. Just before we take that break, Vijay Chopra, do you track Supreme Petchem? It's recovered a bit of lost ground earlier in the day. And numbers that analysts are penciling in and what the management spoke about because of newer capacities coming on stream, don't make it that expensive a stock, maybe trading at circa 20 times FY26.
Well, I suppose that the kind of progress the company has made, and I was just listening to the management, and Mr. Nayyar was quite positive and confident upon achieving those numbers. So it's a forward-looking management. I think the stock has done stupendously well. It is not expensive at all, and the kind of addition they are doing to the top line is really commendable. So I would say that wait for the budget. Again, I'm saying that just don't rush and buy stocks. Although I find that it is a good company to have in a portfolio, best around maybe 750 if you are able to get it in some corrections. 750 would be a very ripe level to get into the stock for the longer term. But yes, I'm happy with the way the management is confident upon achieving numbers in future.
Well, most managements do seem to be fairly optimistic, unless their IT managements were honest to a fault. The guidance sort of spokes the markets. Just another space, Aditya, I quickly want your take on before we get into a quick break, is on your energy space, your oil and gas. HPCL, BPCL, in any of those that you think are poised for better moves right now, budget or no budget?
They entered into consolidation phase, Tamanna, I would say. If we talk about the OMCs, particularly here, I don't see a major correction coming in any of these stocks, but I don't see an immediate up move as well. So maybe a post-consolidation stocks will see a run up again. If we talk about Hindustan Petroleum specifically, on the downside, 330, 320 is a good support area. On the upside, I think so stock can test levels of 390. Same holds true for IOC as well. Stock does look interesting. It's just that all these three stocks have entered into a consolidation phase. That's it, Tamanna. Otherwise, all three stocks look attractive on the chart setup. If you are looking at a positional trade, maybe for a quarter or so, then you can definitely add on to these stocks in your portfolio.
Okay, we'll take a very short break. On the other side, we come back with the F&O setup ahead of the big day, and we'll also talk a bit about one concurrent theme coming in from policymakers. It's in the economic survey. It's something that the SEBI chief also talked about later last week. It's concerns about derivative volumes. Does that hold clues for action that could be taken in or after the budget? We have that conversation when we come back.
Co-powered by Canara Bank. Together we can.
Associate partner, Radico, Spirit of Excellence.
It's the most important union budget in many years. And all eyes will be on how the finance minister builds the road to Vixit Bharat.
We are working to make India a Vixit Bharat by 2047.
But not without a fair share of politics. Will there be a tilt towards populism? How will the finance minister balance between welfare, capex and fiscal discipline?
We get you the most comprehensive news and views on budget impact for investments, the taxpayer and the economy. Ride the bullish India wave only on NDTV Profit.
A powerful driver of India's growth. The Indian economy, development of all regions, technologies and innovations. Inflation is moderate. Investments are robust. More comprehensive GDP.
एक ही लक्ष्य, नेशन फर्स्ट, एक ही इरादा, 2047 विकसित भारत।
This is NDTV and you're watching NDTV Profit. In association with Samman Capital.
Back with India market close right here on NDTV Profit. Let's go across to Agam Vakil, who is standing by with the key derivative picture ahead of the budget day. Agam, I mean, what is the data looking like?
Well, it's very interesting, Neeraj, but it does seem at the moment like Nifty will face resistance at the mark of 25,000. And remember that particular mark isn't too far away from current market levels, because it just requires about 2.5% move on either side, and we actually could breach a psychological level. Of course, on the lower end, we're keeping an eye on 24,000, and on the higher end, keeping an eye on 25,000. It's not just a psychological level, it is also an important technical level, because this is where we have a significant amount of writing when it comes to the respective options. But any trader worth their salt will tell you that to trade an event is also we're taking an extremely high risk, especially if you're actually going ahead and selling those options, which also means that if you in fact do see the Nifty breach any of these levels on the higher end or the lower end, you could potentially expect some of these positions to move out the way, and because of that unwinding, it could further exacerbate that direction as far as the Nifty is concerned. But at the moment, we are still seeing a lot more resistance at the 25,000 mark as compared to the support at the 24,000 mark. Today, of course, was a day where it's turned out to be a flat movement. We are not seeing too much change in open interest. It's the same for the Bank Nifty. Again, we're keeping an eye on the lifetime highs for the Bank Nifty, which is still a bit further away from current market levels on the higher end. Besides that, in terms of your overall levels, as I was mentioning, it is essentially 25,000 on the Nifty that we're keeping an eye on the higher end, and 24,500 on the lower end is where we are at the moment. But 24,000 will also be very, very critical. Besides that, in terms of stocks, again, today was a day where we had relatively quieter moves, but longs for something like Shriram Finance, Abbott and Alchem Laboratories, and among stocks which saw unwinding, we saw short covering for L&T Tech, Tata Chemicals, Gujarat Gas, PVR, Inox, as well as something like Ramco Cement. All in all, it was still a mixed day of trade, and I'd reckon a lot of traders will still wait to perhaps place aggressive bets before we have the outcome of the union budget, and not before that.
All right, so there will be a bit of wait and watch. I found that interesting, Agam, talking about 24,000 at one end and 25,000 at the other end being, the two levels that we could see. And of course, the big question, I think, Neeraj, no one is really talking about it, but at the back of the mind, the big question for the market is that is there going to be some kind of punitive action to rein in volumes in derivatives markets? And the reason I'm saying that is all of the smoke signals which are coming from every end, and I'm not just talking about the SEBI chief saying very clearly that this has become now a macro issue. Look at what the economic survey said, and just the numbers. The number of unique tax IDs registered on the NSE has risen from 2.7 crores in FY19 to 9.2 crores in FY24. So you've had over a threefold increase. Most of the new retail investors are likely young and may have a higher risk appetite. It is also reflected in the interest that retail investors have shown in derivatives trading, especially expiration day trading. They're saying that they are mostly speculative instruments. The long and short of it is, they're saying that if people lose money in large quantities, they'll be cheesed off for a while and could feel cheated, quote unquote. That's actually there in the document. Now, they say this. SEBI chief comes and talks about how this has now become a macro issue. The question becomes that is there something in the offing that we could see either tomorrow or in a few weeks from then?
And safe to think that it is plausible, right, Tamanna? If it doesn't come, it's separate, but very likely because yes, said of the noise. And remember, this follows a report that came in sometime last calendar, wherein the SEBI said that 89% of derivative traders lose money, only 11% make money. So yes, there is certainly a serious think around the rising derivative volumes across parties, across regulators, and I would say across market participants as well. In fact, can we hear out Madhvi Puri Butch, the SEBI chairperson, talking about this at an event organized by the SBI Mutual Fund?
If you see the volumes, the way that they have grown over the last 3 years, I don't think anyone could have anticipated that. If you see the number of young people who have entered that entire process and have lost tons of money, no one could have expected to see that. It has now reached a scale where we believe that the micro objective of protecting the individual investor has changed and morphed to thinking about the macro issue of saying, is this what our market is designed to do, to basically facilitate a lot of speculative transactions? Or at a macro level, are we worried that household savings are now going not into capital formation, but into speculative activity? So what has changed over the 3 years, the facts that have changed, is it has gone from being a micro issue of an investor to a macro issue of the economy itself. And therefore, we felt compelled that we must review our stance. As you know, we've been saying this for a long time. SEBI now eschews dogma and only follows data. Data and no dogma. So tomorrow, if the facts change again, we will change our views again.
So she said this on 19th of July. I'm just going to get a quick word from Vijay Chopra on whether this is a factor at all. Vijay, even with a lot of market participants coming and saying, don't throw out the baby with the bath water. Maybe make fixed deposits more compelling, etc. No need to strangle a fledgling market that's growing.
There are two parts to it, I guess. What SEBI is saying is also right. But who has started expiries every day? Has it happened without SEBI's approval? And, they are coming very heavily on finfluencers. But I see every now and then, I was traveling outside my city. Yesterday, I was seeing that there are so many people who are doing, literally tuitions in how to earn in stock markets and how to earn money in options. And if you go to Twitter or any social media, platform, you see tons of people still doing it. So who has started it? They started the fire. And now probably even Shaktikanta Das came up and said that the deposits are going down tremendously and the money is going into the markets and mutual funds, and Madhavi Buch said that there's no capital formation happening and people are just losing money. So there are this coin has two sides, and they have to look at whether they can actually reduce the number of expiries. Was the earlier system of Thursday expiry good enough? I think it was. So why to push people unnecessarily? Now the point is, this new generation of investors, or I would say traders, who have entered, they have very, very less experience. They have not seen any major corrections.
Yeah. So I want to get Aditya's view on it. Do you think some tempering could come, is required?
Absolutely, Tamanna. I think, and I agree with Vijay, you can't blame the influencers or anybody else. Everyday expiry is not something that is going to help the market. Collectively on NSE and BSE, the overall volume of the FNO in the world is 81% is driven by NSE and BSE combined. So that tells you the kind of volume that is there in India as far as the FNO space is concerned. 81% of the global volume totally driven by NSE and BSE. So that is massive, and that is something that needs to be curbed, because clearly that is a speculative trade that most of the traders are taking, and rightly so, because it's the young generation and they have the appetite to lose money, and they keep on losing money, but they're not building any wealth. There's no wealth creation if you lose money on FNO. So definitely there has to be some curbs, and I am in for those curbs. Maybe bring back the old method of Thursday expiry and have higher risk if you have to increase the lot sizes, increase the VAR. You can do several parameters, several checks to deter people to enter into FNO speculative trading especially.
Okay, so that's on the big topic, and let's see if tomorrow the budget has. Now, last 15 minutes of trade left. Some names, some PSUs which have gained. Aditya, just wanted your view if you trade any of these from the current levels. RCF, NBCC, or a Cochin Shipyard?
NBCC is something, Neeraj, that I like, even though last week's stock did see a massive correction. But I think at current levels, again, it did take support at key areas, and from there it's bounced back. So NBCC is something that I like. I would initiate a trade here with a stop loss just below 180. maybe close to about 175, 176 odd levels for a target of 200 on the upside. And Cochin Shipyard, on the other hand, definitely is something which is interesting. But yes, the risk to reward is maybe 1:1. So on the upside, 2,900 is the target. On the downside, 2,400 is the stop loss. If somebody is okay with that 1:1 risk to reward, then Cochin Shipyard is something, yes, one can look at.
Vijay, do you track the hotel space? Indian hotels, chalet hotels, both of them are up and about. Are you an investor or a buyer at these valuations?
Well, the valuations are definitely steep, let me tell you. And I would definitely wait for a correction. I would just not jump and buy. Indian hotels has shot up today, but I think that, if at all somebody wants to buy, 540, 550 level is a great level to get into this company. I respect the entire group and I track the entire group. They have done fantastically well in the last 5-6 years. And Indian hotels definitely is one of my top picks in the entire space. But definitely, there's one hotel chain called Hotel Leela Ventures, which I, track a lot, HLV. And I often go to Leela Hotels also. I have some membership there. So, I find that, they're doing some brisk business. And this is one stock which has not actually come up, and, the valuation mismatch is definitely there. ITC is also one of the major shareholders along with JM. So, this is one stock I would look at post-budget. I think there's a lot of valuation.
ITC, in fact, there's some very positive notes out on ITC today. So, I mean, not really because of their hotels business, but yes, the hospitality space is interesting. And this is something that, Puneet Chhatwal said to us also in a conversation I had with him earlier today. Because Q1, believe it or not, I mean, the way that stock has moved would not tell you that, but Q1 has been a little slow because of heat waves, elections, and also because the Shadi season did not fall. Those dates have not fallen in this quarter, but July has already been quite a banger. Listening to what Puneet Chhatwal, MD and CEO of IHCL, has said.
Elections, code of conduct, no government delegations coming into India, whether minister level or heads of states. The SIA dates, the auspicious dates moving into July. So, and you've heard all about the great weddings that have happened in the month of July already. So all in all, I think we are on a good way forward. And more important in all this are the macroeconomic changes. Number one, demand remains strong and supply remains constrained, and demand is expected to outpace supply over the next 3 years at a minimum. Number two, we have a very good landscape in 125 plus locations in India, and India is experiencing good GDP growth, and good GDP growth is good for our sector. Number three is the investment that the government has incurred in the infrastructure, in terms of new airports, in terms of renaissance of train stations, and the 6-lane highways, the way they are coming. This should encourage more and more travel. So all in all, with all these factors, I think the sector is well positioned and a lot of activity is happening. If we look at it post-COVID, the sector has experienced not just from a room nights and a demand point of view, but the activity in the sector, the private capex that is going into the sector in building new properties is one of the highest. Actually, till last year, it was the highest private capex was in the hotel sector.
Okay, so it's been a good year, and remember, IHCL still has a guidance for double-digit revenue growth, even though Q1 has been soft. Q2 is usually traditionally softer than Q1, but they think it'll be different. And the big bet, of course, on foreign tourists returning in October. Anyway, we are just a few minutes away from closing bell. But what are the expectations for budget tomorrow? We spoke earlier in the day with Gautam Duggar of Motilal Oswal and Nirmal Bank's Rahul Arora, who laid down their views on budget 2024 and the impact possibly on markets.
I think we overhyped this event too much. If you see the last 7-8 years, you would notice that budget gets discussed 24 or max 48 hours. After that, market forgets the budget and goes back to fundamentals. I don't think why this time it should be any different. Yes, there are some expectations because this is the first budget of the Modi 3.0 government, and clearly the setback that they've received in the elections. So there are some tinkerings that can happen in the overall budget numbers. But broadly, I think the policy of fiscal conservatism and overarching focus on capex should continue with a little bit of tilt or some allocation given to bottom of the pyramid or middle class or tax giveaways, so have you, because you have 1.5 lakh crore of extra firepower available thanks to the RBI dividend. So I hope the government utilizes it sensibly and encourages consumption at the bottom, because that is one area which has been severely lagging in the last 2.5 years if you look at the corporate results.
I still think in the BFSI sector as a whole, valuations are not demanding. I mean, the elephant in the room, HDFC Bank, currently trades at about 2.2 times 1 year forward price to book. They've grown their NIS by 26%, their profits by 35%. I mean, I don't know what else the street wants from this company, but I think, names like this, I think you have value picks even in the insurance sector. I think there is some value even on the gold finance side. Something like a Manappuram Finance, where for a 16-18% return on equity trading at 1 times price to book. So I think definitely BFSI is one place where you could look at.
All right, so these are some of the spaces that you could look at in this budget. Let me talk about BFSI for just a second, and Aditya, let me come to you. HDFC Bank, I think, was the positive surprise of the day. But apart from that, anything that you are tracking right now and keeping on your list in the BFSI space?
Bajaj Finserv, Tamanna, I think this is one stock which has been neglected big time, and I think so it's time to look at that stock. Again, this is more from a positional point of view. If somebody wants to buy the stock at current levels, somebody can do that. And I'm looking at a target of 1900 plus on the stock. So between 1900 and 2000 is what I'm eyeing for the stock. On the downside, 1500 is a very strong support area for the stock. So I think it's a matter of time before it breaks out and tests those levels of 1900, 2000. One can definitely start nibbling into Bajaj Finserv from the BFSI space, definitely.
Okay, so Bajaj Finserv is one of them. Vijay, do you have any favorites in this space? You're on mute, Vijay.
Yeah, I think that I would wait for tomorrow's action, and then would take would give some recommendation. I like a lot of banks, although Midcap bank, PSU banks, but I would love to wait for a day or so and then probably recommend.
But Vijay, while you wait, what is on the list though?
Well, I think there are good banks like Indian Bank, Bank of India, Bank Baroda, Can Bank. I like these companies. The Canfin Home has corrected a bit, but I think that, these home finance companies look very good. Companies like Poonawalla Fintech, Poonawalla Finance, they look very good. So a lot of companies are there, but, I'm just wary of if there is some kind of a negative news flow, these companies might react negatively. So I would just wait for a day or so. And then take an informed decision. So I've mentioned quite a number of companies where I'm looking at.
Okay, so those are some of the ideas in the financials space. Is IT a no-go area right now, Vijay? I mean, apart from tomorrow, I know tomorrow you're taking a break from all this, but
well, I think that I was recommending IT almost 6 months back. And I also recommended, because, if you're a trader, you should book profits. So we actually, we manage portfolios. So we actually book profits in TCS, in Infosys and other companies. Infosys actually ran up quite a bit. But I think that, post some correction, I would definitely love to get into IT with a, short to medium term perspective. But right now, I won't say that you jump and buy.
Okay, so don't jump and buy right now. All right, let's just take a look at what's really moving as we get into close, and just pull up the heat map as far as the Nifty is concerned. We'll get to the top gainers and losers in the broader markets as well. So completely flat on the markets is what I would say. The Bank Nifty marginally in the green right now, and that too would be thanks to HDFC Bank in a large part. In terms of the losers, Wipro leads the pack undoubtedly across the board. Tejas Networks also doing quite badly, and despite the numbers looking fairly decent, down 6.5%. Phoenix Mills is hurting, as is quite a few realty companies. Raymond continues to have a very tumultuous time. On the winning side, it continues to be all about, I would say, fertilizer stocks, even some affordable housing plays. Look at an NBCC today. I want to see what Aavas and Hutco are doing. And these will be key themes ahead of the budget. NBCC up about 8% nearly, Hutco also up in the green. We'll see what Aavas Finance is doing. So these are some of the plays you need to look at. Indian Hotels, we talked about. Aavas Finance also up about 3%. Indian Hotels, Chalet are some on the tourism or say hospitality side, which are doing fairly okay. But as far as realty space is concerned, apart from an Oberoi Realty, everything else hurting quite a bit. Hudson Agro, which was flying because of their numbers, has seen some profit booking coming in, and banks apart from an HDFC are not doing too well either. So I would say it's a very careful wait and watch day. I think a lot of people have the same idea Vijay has, to sit on the sidelines for some time. But Aditya, once you have the budget sort of out of the way and some clear picture, if there's going to be a huge departure, huge increments, what would be the sort of strategy that you would come back with, say on a Wednesday?
Someone I would stick to large caps predominantly, because I still believe this is one space where there is under ownership and a lot of room for outperformance, because the mid cap over Nifty and small cap over Nifty, the ratios are trading at all-time highs. So that clearly shows that there's a massive underperformance from the large cap stocks. You name it, be it Reliance, be it TCS, be it HDFC Bank, Infosys, all of them underperformed. So I think it's time to look at these names. Reliance, why not? It's down 3%. Very close to its support area of 3,029.50. I would be a buyer in Reliance. If you were looking to buy Reliance today, is the best opportunity to go long on Reliance. HDFC Bank corrected from the top, I think, so it's again a very good opportunity to buy them. And IT stocks, again, I think IT will continue to outperform. If anything, we did analysis on the sectoral performances post-elections, and IT is the biggest gainer 6 months post-elections. They gained 36% on an average, and we did this for the last 4 elections. So overall, I think I will stick to large cap names, and these are some of the names which I think should be looked at if you're looking to build your portfolio. Reliance, HDFC, TCS, Infosys, HCL Tech, all these stocks I think should be looked at, and maybe an Asian Paint, something not immediately, but once the consolidation is over, I would look at Asian Paints as well.
Okay, interesting. Aditya, Vijay, gentlemen, thanks so much for taking the time out and being with us. Really appreciate your time this afternoon. Let's start wrapping up the markets, and it's for the PSUs, it's a happy hunting ground. Otherwise, it's a flat market. A flat market belies though what's happening underneath, because a lot of heavyweights have cracked quite significantly. We should pull up the India VIX for a moment before we get to individual stocks very quickly. The India VIX, not a dramatic uptick. In the morning was a bit higher, but doing okay. Get the heat map up on the screen, and you will see a Wipro, Reliance, Kotak Bank down at the bottom of the pile, and then an ITC following suit along with an SBI. But HDFC Bank with 2% gains is thwarting some of that pain, and along with an NTPC, a Grasim, Ultratech and a few others has done well. Must say that I think it's HDFC Bank's uptick that is helping the market still stay this way, because otherwise on a day when Reliance falls 3.5%, it's very difficult for the markets to see that bit of an uptick. And before Tamanna comes here, just this is the important piece. HDFC Bank, like I said, 60 points trying to thwart some of the downtick pressure that Reliance Industries has put on the indices today. Kotak, ITC and Wipro are the other ones, Tamanna. Yeah. But good names, good move from Infi too in the session today. That 1% uptick, but heavyweight and therefore a little bit of green contribution.
Yeah, so I would say if you look at it from the perspective of how the market started, it's not half bad, Neeraj. And that too, you have some comeback kings and queens here, which would be in the form of your fertilizers, your affordable housing plays. So a bit of that needs to be put into context as well. Look at how the mid cap and small caps are closing a day before, just before the budget session, and that's a big day. Mid caps have seen a decent recovery. And there you have it, still up about 1.5%, 700 points up on the Nifty mid cap, the Nifty small cap also about 1% up. So you have seen a decent recovery here. I'm just going to pull up the gainers and losers on the BSE 500 before we wrap for the day. And remember, a whole lot of programming coming up on NDTV Profit. Wipro is the top loser, no prizes for guessing why. I don't know if they deserve to be beaten down so much, but yeah, Wipro is hurting, so is Tejas Networks, that's again results. Phoenix Mills sulking with a lot of other real estate companies as well. So those are some of them. This has been one of the big culprits about why you're seeing your key index, your Nifty, with a bit of pressure. But look at this side. I think this is interesting and telling me that there's a bit of IT budget play back on hand. RCF nearly 10% up, and NBCC up there. Fact has also done fairly well today. And Indian Hotels and Chalet. Maybe we could see some big boost for tourism, because remember, if you want to focus on jobs, that's one sector.
Yeah, also the commentary about July being so strong from Indian hotels also helping.
But Chalet also jumping up.
So, I mean, what would be good for Indian hotels, possibly for the space at large? And very interesting, because Tamanna pointed out RCF, Deepak Fert and some of the others too have done well. So fertilizers certainly doing well. But like Tamanna said, a lot of programming on the other side. But for now, thanks for tuning into this show from Tamanna and me and the team that put this show together. Thanks so much for watching.
Co-powered by Canara Bank. Together we can.
Associate partner, Radico, Spirit of Excellence.
ਰੰਗਲਾ ਪੰਜਾਬ 'ਚ ਬਣਾਉਣਾ ਉਹਦੇ ਵਾਸਤੇ ਸਿਹਤਮੰਦ ਪੰਜਾਬ ਪਹਿਲਾਂ ਚਾਹੀਦਾ 96 ਤੋਂ 97% ਲੋਕ ਜਿਹੜੇ ਨੇ ਉਹ ਮੁਹੱਲਾ ਕਲੀਨਿਕਾਂ 'ਚੋਂ ਠੀਕ ਹੋ ਕੇ ਘਰੇ ਵਾਪਸ ਚਲੇ ਜਾਂਦੇ ਨੇ ਸਰਕਾਰੀ ਹਸਪਤਾਲਾਂ ਤੇ ਬਰਡਨ ਬਹੁਤ ਘਟ ਗਿਆ
ਮੁਹੱਲਾ ਕਲੀਨਿਕ ਜਿਹੜਾ ਬਣਿਆ ਹੋਇਆ ਉਹਦੀ ਬਿਲਡਿੰਗ ਬਹੁਤ ਅੱਛੀ ਬਣੀ ਹੋਈ ਹੈ ਉੱਥੇ ਸਭ ਤਰ੍ਹਾਂ ਦੀਆਂ ਫੈਸਿਲਿਟੀਆਂ ਦਿੱਤੀਆਂ ਹੋਈਆਂ ਸਰਕਾਰ ਵੱਲੋਂ
2 ਹਫ਼ਤੇ ਤੋਂ ਖੰਘ ਨੇ ਬਹੁਤ ਪਰੇਸ਼ਾਨ ਕਰਿਆ ਤੇ ਜੀ ਮੈਂ ਪਹਿਲਾਂ ਬਾਹਰ ਪ੍ਰਾਈਵੇਟ ਦਵਾਈ ਲੈਂਦਾ ਰਿਹਾ ਫਿਰ ਇੱਥੇ ਆ ਕੇ ਲੱਤੀ ਜੀ ਟੈਸਟ ਫ੍ਰੀ ਹੋਇਆ ਇੱਥੋਂ ਮੈਂ ਠੀਕ ਹੋ ਗਿਆ ਹੁਣ ਮੈਂ ਠੀਕ ਹਾਂ ਬਿਲਕੁਲ
ਸ਼ਾਨਦਾਰ ਮੁਹੱਲਾ ਕਲੀਨਿਕ ਹੈ ਸਫਾਈ ਹੈ ਔਰ ਡਾਕਟਰ ਉਹਨਾਂ ਦੀ ਜਿਹੜੀ ਦਵਾਈ ਲਿਖਣੀ ਹੈ ਉਹ ਕੰਪਿਊਟਰ 'ਚ ਐਡ ਕਰ ਦਿੰਦੇ ਨੇ ਜਿੱਥੇ ਦਵਾਈ ਲੈਣੀ ਹੈ ਉੱਥੇ ਤੱਕ ਕੰਪਿਊਟਰ ਪਹੁੰਚ ਜਾਂਦੀ ਹੈ ਟੋਟਲ ਪੇਪਰਲੈਸ ਹੈ
ਮਾਨ ਸਾਹਿਬ ਨੇ ਬਹੁਤ ਵਧੀਆ ਉਪਰਾਲਾ ਕੀਤਾ ਵਧੀਆ ਕੰਮ ਕਰਿਆ ਸਰਕਾਰ ਨੇ ਗਰੀਬਾਂ ਦਾ ਭਲਾ ਕਰਤਾ
ਪੰਜਾਬੀ 'ਚ ਕਿਹਾ ਜਾਂਦਾ ਹੈ ਬਾਕੀ ਦੇ ਕੰਮ ਬਾਅਦ 'ਚ ਪਹਿਲਾਂ ਸਿਹਤ ਜ਼ਰੂਰੀ ਹੈ ਸੋ ਅਸੀਂ ਜਦੋਂ ਸਹੁੰ ਚੁੱਕੀ ਤਾਂ ਪਹਿਲੇ ਹੀ ਸਾਡਾ ਵਿਜ਼ਨ ਇਹ ਸੀਗਾ ਕਿ ਪੰਜਾਬ ਦੇ ਵਿੱਚ ਹੈਲਥ ਟੌਪ ਕਲਾਸ ਦਾ ਇਲਾਜ ਹੋਵੇ ਸੋ ਇੱਕ ਮੈਡੀਕਲ ਹੱਬ ਦੇ ਰੂਪ ਦੇ ਵਿੱਚ ਅਸੀਂ ਸੋਚਿਆ ਔਰ ਮੈਂ ਕੋਈ ਆਸਾਨ ਨਹੀਂ ਕਰ ਰਿਹਾ ਤੁਹਾਡੇ ਤੇ ਮੇਰਾ ਫਰਜ਼ ਹੈ ਜੀ ਇਹ
You know, जब भी घर की बात आती है तो 2 बातें सामने आती हैं रेंट का घर या अपना घर अपना घर हो तो फिर 2 बातें इस बैंक से लोन या उस बैंक से लोन फिर मेरी इन 2 बातों पर फुल स्टॉप लग गया जब मुझे यूनियन बैंक से हैसल फ्री लोन मिला
राज मैं सलवार सूट पहनूं या जंपसूट
अब इन 2 बातों का कोई कुछ नहीं कर सकता
यूनियन बैंक ऑफ इंडिया अच्छे लोग अच्छा बैंक
World Food India 2024, aiming to become the food basket of the world. A global event to showcase the food processing prowess of India. Ministry of Food Processing Industries, Government of India invites you to World Food India 2024, 19th to 22nd September, Bharat Mandapam, New Delhi.
This is NDTV, and you're watching NDTV Profit. In association with Samman Capital.
welcome to the special show called Budget Trades. As we go into the much anticipated event tomorrow, we have with us two special guests, Gautam Dugar, Head of Research, Institutional Equities of Motilal Oswal, joining us, and Rahul Arora, Head of Institutional Equities at Nirmal Bang, talking to us about what the markets are expecting and how much of this is already in the price. Thank you very much for taking out the time to talk to us. To begin with, there's so much I know happening. Budget is just one of those many events that the markets are currently working with and grappling with. But let's start with that, right? With a weaker than expected mandate for the BJP, there is some sort of nervousness in some parts of the market which do believe that the budget could be a lot more populist than the equity markets would have liked. Do you agree? Do you feel that nervousness is justified at this stage?
Good afternoon, Samina. Thank you for having me on the show. So I think that's a reasonable assumption to make. I think if you look at countrywide, when you look at states like Telangana, Jharkhand, Maharashtra, I think some populist measures have already started on the ground, whether it's with respect to farm loan waivers, increasing PM Kisan, and so on and so forth. But it would not be an unreasonable expectation to expect that the tilt would be more towards populism than capex in this budget. That being said, I don't think they're going to take the foot off the pedal as far as capital expenditure is concerned, because I think if you look at the last 10 years of the current establishment, capex growth in the first 5 years on a CAGR basis was about 15-16%. That dropped down to about 8% for the remaining 5 years, that is FY19 to 24. Obviously, you had 2 years of COVID in that, where not too much capex happened, but still, an 8% CAGR is not something that they would want to go down from. So I don't think they'll necessarily take the foot off the pedal, but yeah, it would not be unreasonable to expect, some kind of a populist tilt. And by populist, I don't necessarily mean dole-outs. Even for the bottom of the pyramid income levels, the tax exemption that people are talking about, if that's increased by 1 lakh or 2 lakhs, and that puts another 10-15,000 in the hands of people to consume, that's another way of looking at populism. So I think all things considered, I think the headline number that everyone is obsessed with in every budget is the fiscal deficit. And I think that will probably be retained at about 5.1%. I can't see them changing that. But like I said, it would definitely be a 60-40 more tilted towards what you would call consumption populism rather than capex.
Consumption populism, which may not be too bad given the fact that rural economy is the one that's struggling, and we saw that at the election outcome as well. But just before we go into that, Gautam Dugar of Motilal Oswal as well joins in. Gautam, hi, thanks for joining in. Gautam, before we talk about the budget, let's talk about how the mood has been on the street. How optimistic, how buoyant, how confident are market participants feeling just ahead of Budget 2024?
Hi, good afternoon. Thanks for having me. I think, the mood is best reflected in the way markets have behaved in the calendar year, and also the way flows have been. In the first 6 months, you've seen close to $28.5 billion coming in from domestic institutional investors, which is, by the way, 30% more than what you've seen in the full calendar year 2023. So market obviously has been on a tear. If you look at the trailing 12-month returns of mid-cap, small-cap indices, today you're talking about a market where mid-cap index is trading at a 60% premium to Nifty. Small-cap index is also now trading at a premium to Nifty. So clearly the mood is very buoyant, and I would even say euphoric in some pockets. Clearly some pockets where earnings have not followed through, valuations have gone for a toss. Right? Insofar as large cap is concerned, clearly things are far more sober, I would say, vis-a-vis what we are seeing in mid and small cap pockets. Nifty is still trading somewhere about 20.5 times, which is broadly in line with the 10-year average. Of course, if you look at the numbers ex financials, valuations look very different, but so be it. Financials is 1/3 of the Nifty weight, so you can't exclude that. There will always be some pockets which are undervalued, some which are overvalued, but broadly, large cap looks okay to me. It's mid cap and small cap where things have gone a bit awry. As far as budget is concerned, I think we overhyped this event too much. If you see the last 7-8 years, you would notice that budget gets discussed 24 or max 48 hours. After that, market forgets the budget and goes back to fundamentals. I don't think why this time it should be any different. Yes, there are some expectations because this is the first budget of the Modi 3.0 government, and clearly the setback that they've received in the elections. So there are some tinkerings that can happen in the overall budget numbers. But broadly, I think the policy of fiscal conservatism and overarching focus on capex should continue with a little bit of tilt or some allocation given to bottom of the pyramid or middle class or tax giveaways, so have you, because you have 1.5 lakh crore of extra firepower available thanks to the RBI dividend. So I hope the government utilizes it sensibly and encourages consumption at the bottom, because that is one area which has been severely lagging in the last 2.5 years if you look at the corporate results.
Rahul, I want to try and understand from you as well, what are your thoughts on the broader markets? I remember a few months ago, it was CLSA that put out a whole list of stocks calling them Modi stocks. There were a bunch of them, and most of these stocks haven't moved very much since the election verdict on the 4th of June. As we go into the budget this time, the bullish sentiment index indicates 92% people are optimistic in that sense about the budget, which makes me believe that with very stretched valuations, extreme optimism around the markets, we may be looking a lot more vulnerable now than we ever have. Would you agree?
So I think, Samina, the one thing that the sell side has got perpetually wrong for the last 10, 12 years that we have seen, and I think everyone collectively needs to take responsibility for it, ourselves and our brokerage included, is we overestimate earnings at the start of every year, and we have to, at the end of the year, downgrade those earnings. And I think this has been a consistent phenomena for years, and if you look at the Bloomberg estimates, they will be no different. You were talking about valuations. I think they have been, when you look at the mid and small caps, they have gone beyond reasonable expectations. I don't even think there is a conversation to be had about whether they're reasonable anymore. When we talk to institutional investors and some of the larger ones, we're actually discussing sell ideas, believe it or not. They actually want to know what to exit rather than what to buy. And I think, I was just looking at, we research about 180, 190 odd stocks, and I was looking at the last 4 quarters data. On average, we have downgraded about 60, 65% every, on a trailing basis every quarter. So you're not in an earnings upgrade cycle by any stretch on an aggregate basis. Will stocks be cheap? Of course, there will be stocks that are cheap at a 24,000 Nifty. There will be stocks that are expensive at an 8,000 Nifty. But I think at an aggregate level, there is just way too much. I think it's beyond price to perfection. Just take a look at what's happening with Wipro today. There is no room for error. If you slip slightly, the market's going to punish you. There seemed to be a semblance of that happening with defense stocks last week. I think we're probably one of the first brokers on the street to actually downgrade the entire sector to a sell, because, it had reached levels that we, did not understand. And we were happy to put that. But I think the way the market is behaving, and this has nothing to do with the budget. And I think, the point has been made consistently, Samina, and you probably, running your shows have got bored of hearing of this, is that it is a liquidity-driven rally. I mean, it is way ahead of fundamentals. Any fund manager, that you speak to will tell you that, for companies that are 20, 25% return on equity or capital employed, stocks are trading at 55, 60 Ps. That kind of makes no sense. So I would personally love it if you had a 15, 20% correction in the market. I think it would restore some sanity. But I think the probability of that, Samina, I've pretty much thrown in the towel. I've got my call on the market consistently wrong. We're up 18% from the 4th of June lows, and nothing has changed in India barring flows. So, if the flows sustain, then, who's to say where we go? But, given where the overall fundamentals are, especially with respect to earnings, I think we're way, way ahead of where we should be.
I think it's uncharted territories, Rahul, and I think people who've been calling it a top, stay on the sidelines, making cash calls all the way back in October, are probably going to be disappointed as we look at things right now. But the fact remains, 20% of Indian household spending is now coming into financial assets, and this money is sticky. So I think that's what we need to be mindful of as well. But let's move on to a few other aspects before we go into earnings and the fact that the markets have borrowed returns from the future. Gautam, one thing that I want to highlight with you and get your perspective on is the monster that rears its head out before every budget, and that's the fear of changes to our capital gains tax regime. The same worries seem to have resurfaced in many quarters, and some believe that this could be almost a given this time around. Do you think Budget 2024 will see any tinkering or changes to the existing capital gains tax regime? As it stands, the current regime is, or the different rates, the different holding periods based on different asset classes. What is your expectation here?
So I don't expect any change. See, it's an annual ritual where we, prior to budget, every year discuss about the bogey of inheritance tax, wealth tax, changes in long-term capital gains tax. So this year is no different. And, everyone goes wrong after the budget is over. So I think government is making good collections on short-term capital gains tax, on STT. So capital markets are doing well. In general, the wealth creation has been pretty phenomenal for the last 10 years also, because Nifty itself has compounded at 16% for last 10 years, mid-cap at 20% and small cap at 24%. I'm talking about a 10-year data. Economy is doing well. Macro, micro are in perfect harmony, I would say. So it will be very, I would say imprudent for a government to now tinker with something which is doing well. And it's not as if that they're going to make a huge collection, even if they change the duration or they change the tax rates much. So at least I don't expect too much sort of tinkering over there. And hopefully this will be forgotten after 48 hours, because tomorrow the entire media investment community is going to get busy discussing this thing. But if you go by the past experience of last 5-6 years, you can check the news flow before the budget. Every time there is a discussion on whether inheritance tax is coming or not, whether there's going to be a big change in long-term capital gains tax or not. I think the way the political results, the mandate has been of 4th of June, I don't think government will take a step where they start antagonizing more middle-class people now. Because if you look at the way equity cult has evolved, in the last 4 years, the demat account itself has gone from 3.5 crore to 16 crore. So equity investment is no longer the reserve of few cities or few pockets. It's spreading across the geography. So I don't think government is going to try and tinker that for a few extra 100 crores or 1,000 crores of money. They can easily get that from some other line items here and there.
Right. Rahul, very quickly, a very unconventional view came about last week, where Chris Wood of Jefferies said that India does not need a capital gains tax regime. And he cited the example of jurisdictions like Hong Kong, which have actually benefited. Do you want to respond to that? Do you feel like there could be some streamlining, or that very, very extremist view coming from Chris Wood's actually holds some value?
I think even if it's to be done, Samina, I don't think this is the right time to do it. And partly because I think, the kind of investors that have come into the market post-COVID, they haven't really seen a bear market. They haven't tested waters. I think, once a lot of these people that have come in, in the age group of 18 to 25, 30, it's too early to set them back with these kind of regulations, is my sense. Would it probably happen over a longer period of time? Yeah, but I think it could potentially derail a little bit of the equity culture that you're looking to establish. If you look at capital markets today, they've become the default funding option. I think, you have flows moving away from fixed deposits into mutual funds. You have promoters looking to tap capital markets to raise money. So I think at this point in time, when it's become the go-to weapon, so to speak, for various aspects, I don't think this is the right time to do it. We can debate on whether there are merits or demerits of doing it, and I'm sure if the government decides to do it, they would see merit in it. But I think at this point in time, when you're just looking at the financialization of savings happening into equity markets, despite these ridiculous valuations, you're seeing 30,000-40,000 crores of flows that are coming in. I don't think, the government would do anything to derail that at this point in time. So look, personal income tax collections are extremely buoyant. I think, we must be one of the very few countries in the world where our growth in personal income tax is more than the growth in the corporate tax rate. And that's one of the reasons why people keep talking about giving tax breaks to the people who actually fund the economy, which is basically people like you and me. But, that becomes counterproductive from the government standpoint at many levels. So I don't think at this point they're going to tinker too much with it. I think it'll probably be counterproductive in their larger scheme of things to be doing anything to capital gains tax at this point.
Right, we'll take a quick break. Rahul and Gautam, stay with us. We'll come right back and continue our conversation, so stay tuned.
जब भी घर की बात आती है तो दो बातें सामने आती हैं, रेंट का घर या अपना घर। अपना घर हो तो फिर दो बातें, इस बैंक से लोन या उस बैंक से लोन। फिर मेरी इन दो बातों पर फुल स्टॉप लग गया जब मुझे यूनियन बैंक से हैसल फ्री लोन मिला।
राज, मैं सलवार सूट पहनूं या जंपसूट?
अब इन दो बातों का कोई कुछ नहीं कर सकता।
यूनियन बैंक ऑफ इंडिया, अच्छे लोग, अच्छा बैंक।
ਰੰਗਲਾ ਪੰਜਾਬ ਜੇ ਬਣਾਉਣਾ ਉਹਦੇ ਵਾਸਤੇ ਸਿਹਤਮੰਦ ਪੰਜਾਬ ਪਹਿਲਾਂ ਚਾਹੀਦਾ ਹੈ। 96 ਤੋਂ 97% ਲੋਕ ਜਿਹੜੇ ਨੇ ਉਹ ਮੁਹੱਲਾ ਕਲੀਨਿਕਾਂ ਚੋਂ ਠੀਕ ਹੋ ਕੇ ਘਰੇ ਵਾਪਸ ਚਲੇ ਜਾਂਦੇ ਨੇ। ਸਰਕਾਰੀ ਹਸਪਤਾਲਾਂ ਤੇ ਬਰਡਨ ਬਹੁਤ ਘਟ ਗਿਆ।
ਮੁਹੱਲਾ ਕਲੀਨਿਕ ਜਿਹੜਾ ਬਣਿਆ ਹੋਇਆ ਉਹਦੀ ਬਿਲਡਿੰਗ ਬਹੁਤ ਅੱਛੀ ਬਣੀ ਹੋਈ ਹੈ। ਉੱਥੇ ਸਭ ਤਰ੍ਹਾਂ ਦੀਆਂ ਫੈਸਿਲਿਟੀਆਂ ਦਿੱਤੀਆਂ ਹੋਈਆਂ ਸਰਕਾਰ ਵੱਲੋਂ।
2 ਹਫ਼ਤੇ ਤੋਂ ਖੰਘ ਨੇ ਬਹੁਤ ਪਰੇਸ਼ਾਨ ਕਰਿਆ ਹੈ ਤੇ ਜੀ ਮੈਂ ਪਹਿਲਾਂ ਬਾਹਰ ਪ੍ਰਾਈਵੇਟ ਦਵਾਈ ਲੈਂਦਾ ਰਿਹਾ, ਫਿਰ ਇੱਥੇ ਆ ਕੇ ਲੱਤੀ ਜੀ ਟੈਸਟ ਫ੍ਰੀ ਹੋਇਆ, ਇੱਥੋਂ ਮੈਂ ਠੀਕ ਹੋ ਗਿਆ। ਹੁਣ ਮੈਂ ਠੀਕ ਹਾਂ ਬਿਲਕੁਲ।
ਸ਼ਾਨਦਾਰ ਮੁਹੱਲਾ ਕਲੀਨਿਕ ਹੈ, ਸਫਾਈ ਹੈ ਔਰ ਡਾਕਟਰ ਉਹਨਾਂ ਦੀ ਜਿਹੜੀ ਦਵਾਈ ਲਿਖਣੀ ਹੈ ਉਹ ਕੰਪਿਊਟਰ 'ਚ ਐਡ ਕਰ ਦਿੰਦੇ ਨੇ। ਜਿੱਥੇ ਦਵਾਈ ਲੈਣੀ ਹੈ ਉੱਥੇ ਤੱਕ ਕੰਪਿਊਟਰ ਪਹੁੰਚ ਜਾਂਦੀ ਹੈ। ਟੋਟਲ ਪੇਪਰਲੈਸ ਹੈ।
ਮਾਨ ਸਾਹਿਬ ਨੇ ਬਹੁਤ ਵਧੀਆ ਉਪਰਾਲਾ ਕੀਤਾ, ਵਧੀਆ ਕੰਮ ਕਰਿਆ ਸਰਕਾਰ ਨੇ, ਗਰੀਬਾਂ ਦਾ ਭਲਾ ਕਰਤਾ।
ਪੰਜਾਬੀ 'ਚ ਕਿਹਾ ਜਾਂਦਾ ਹੈ ਬਾਕੀ ਦੇ ਕੰਮ ਬਾਅਦ 'ਚ, ਪਹਿਲਾਂ ਸਿਹਤ ਜ਼ਰੂਰੀ ਹੈ। ਸੋ ਅਸੀਂ ਜਦੋਂ ਸਹੁੰ ਚੁੱਕੀ ਤਾਂ ਪਹਿਲੇ ਹੀ ਸਾਡਾ ਵਿਜ਼ਨ ਇਹ ਸੀਗਾ ਕਿ ਪੰਜਾਬ ਦੇ ਵਿੱਚ ਹੈਲਥ ਟੌਪ ਕਲਾਸ ਦਾ ਇਲਾਜ ਹੋਵੇ। ਸੋ ਇੱਕ ਮੈਡੀਕਲ ਹੱਬ ਦੇ ਰੂਪ ਦੇ ਵਿੱਚ ਅਸੀਂ ਸੋਚਿਆ ਔਰ ਮੈਂ ਕੋਈ ਸਾਨ ਨਹੀਂ ਕਰ ਰਿਹਾ ਤੁਹਾਡੇ ਤੇ, ਮੇਰਾ ਫਰਜ਼ ਹੈ ਜੀ ਇਹ।
This is NDTV, and you're watching NDTV Profit. In association with Samman Capital.
Welcome back. You're watching Budget Trade. We have with us Gautam Duggad and Rahul Arora talking to us about the budget and the markets as whole. Rahul, let's get down to actionables now and what investors should be doing. I know most portfolios haven't done half as well as the index itself, and there is still a feeling of, FOMO in that sense. What do you recommend investors should do? Should they take profits off the table? Reinvested in a staggered manner? Would you recommend them keeping some dry powder for a potential correction and a better opportunity to buy? If yes, what sort of levels would those be? Because from where we stand right now, we definitely have borrowed significant returns from the future already.
So I think, Samina, wherever your stocks are trading at north of 50, 55 times on a 1 year forward, I think the answer is very evident. You can certainly sell. I think where you can move in is where valuations are still reasonable. I still think in the BFSI sector as a whole, valuations are not demanding. I mean, the elephant in the room, HDFC Bank, currently trades at about 2.2 times 1 year forward price to book. They've grown their NIS by 26%, their profits by 35%. I mean, I don't know what else the street wants from this company, but I think, names like this, I think you have value picks even in the insurance sector. I think there is some value even on the gold finance side, something like a Manappuram Finance, where for a 16-18% return on equity trading at 1 times price to book. So I think definitely BFSI is one place where you could look at. I think technically, Samina, the market was underweight on IT services. And I think that's why, barring Wipro, I think the other IT results that you have seen have been very easily bought into. Add to that the potential, noise that has been increasing as far as the Trump presidency goes. I mean, a lot of polls are putting him ahead. That could potentially bode well, because I think if you look at, how globally things stack up under Republicans versus Democrats, the overall environment may actually be more conducive towards spending in the United States, particularly because Trump is a capitalist. And given the BFSI exposure that you have for Indian IT companies, I think IT could be an interesting play as well. And go back to where we started this conversation, Samina, if the government does indeed decide to tilt a little bit towards consumption, again, that same technical factor of under ownership is there in consumer staples. So I think there could be potentially some interest moving into names like an ITC, Dabur, etc., if the rural recovery takes place. So I think there are still some pockets. And lastly, maybe cement. I know Ultratech wasn't a great bag, but I think that could potentially, because the first order that the Prime Minister signed when he came back into office was a housing order. And I think NHAI's, road allotments last year were not that good. They'll probably pick up this year. So I think these are 3-4 sectors where valuations are not as demanding today as probably the rest of the market are. So you can certainly take profits in companies where, your stocks are trading north of 50-55 times and look at entering some of these stocks and sectors.
Okay, so that's BFSI, insurance, consumer staples, cement. Rahul's been kind enough to name a few like HDFC Bank and the likes of a Dabur that one could allocate to, an IT as well. Gautam, what about you? What does your portfolio stand currently? Have you recommended to your clients to sit on cash? If yes, how much? And if there is a re-entry point, where would that be and where would that money go into?
So we just published our model portfolio a fortnight back. We made several changes. We had gone overweight on IT, overweight on pharma from being underweight and neutral earlier. We have reduced auto from overweight to underweight now. We continue to be significantly overweight on PSU banks. We find valuations very attractive even now. In private banks, we are slightly underweight because of our underweight stance on HDFC Bank since 2 years now. So that stance continues. But within the private sector banks, we are overweight on ICICI and Axis. Then we are overweight on industrials and real estate, which played out beautifully. But now we have to reassess given where relative risk reward lies. And as far as underweight is concerned, we are still underweight on energy. We are underweight on metals and also on cement. So our entire capex and industrials weight is lying in capital goods and minor weight in defense. And of course, big overweight on real estate. So net-net, we are trying to move the portfolio slightly more defensive, which is why you have seen a change in allocation towards IT and pharma. And then in consumption, we have a huge weight. We have about 20% weight in consumption, but within that, discretionary has been our preferred choice. So out of that 20% weight, staples is only 4% and 15% is consumer discretionary, where we have names belonging to jewelry, hotel, QSR, food delivery, then cables and wires, all sorts of things. So from a slightly longer term perspective, we've been more positive on discretionary versus staples. But staples opportunistically one can play for this budget event. I don't expect any significant pickup in volume growth there. Maybe something which is growing at 2-3% volume can grow at 4-5, but it won't change the trajectory of earnings growth beyond a point.
Well, thank you very much, Rahul and Gautam, for joining us today on this edition of Budget Trades, just ahead of the big event tomorrow. While you said, or both of you said, that this event is a 24-hour event and markets are so much more beyond that, but significant because it gives us an opportunity to talk to guests like you and build perspective for our viewers. But on that note, thanks for watching. There's a lot more programming on the other side, so keep it with the channel.
ਰੰਗਲਾ ਪੰਜਾਬ ਜੇ ਬਣਾਉਣਾ ਉਹਦੇ ਵਾਸਤੇ ਸਿਹਤਮੰਦ ਪੰਜਾਬ ਪਹਿਲਾਂ ਚਾਹੀਦਾ 96 ਤੋਂ 97% ਲੋਕ ਜਿਹੜੇ ਨੇ ਉਹ ਮਹੱਲਾ ਕਲੀਨਿਕਾਂ ਚੋਂ ਠੀਕ ਹੋ ਕੇ ਘਰੇ ਵਾਪਸ ਚਲੇ ਜਾਂਦੇ ਨੇ
It's the most important union budget in many years. And all eyes will be on how the finance minister builds the road to Vixit Bharat.
We are working to make India a Vixit Bharat by 2047.
But not without a fair share of politics. Will there be a tilt towards populism? How will the finance minister balance between welfare, capex and fiscal discipline?
We get you the most comprehensive news and views on budget impact for investments, the taxpayer and the economy. Ride the bullish India wave only on NDTV Profit.
A powerful driver of India's growth. The Indian economy, development of all regions, technologies and innovations. Inflation is moderate. Investments are robust. More comprehensive GDP.
ही लक्ष्य, नेशन फर्स्ट, एक ही इरादा, 2047 विकसित भारत।
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
एक ही लक्ष्य, नेशन फर्स्ट, एक ही इरादा, 2047 विकसित भारत।
And to begin with, we're going to quickly take a look at how the markets have performed. Do remember that this is crucial today in terms, of course, of the budget being presented tomorrow. And we are cutting across right now to Harsh, who has all the latest from the markets. All right, we'll play that out for you in just a bit, but let's now move on to what's happened in terms of the economic survey. Now, straight to that big story, India's dream of becoming a developed nation by 2047 is finding special mention in the economic survey. Now, the survey has advocated a six-pronged policy approach for the Modi government. It is possible that the budget may lay the roadmap for the economy, keeping Vision 2047 in focus. The following are the key areas for policy action. Primary amongst these strategies, of course, is to ensure that capital formation in the private sector grows organically and steadily, delivering endogenous growth in jobs and a fair share of income for workers. Second is financing green transition as well as India growing in an area where public-private partnership will be critical. This needs to be innovative. Those are the key takeaways. Now, from the risks to growth areas of policy focus and an outlook on price and inflation, we're going to go across to Pallavi, who's joining us with the key takeaways from the economic survey. Hi, Pallavi. Take us through the big salient points of this survey.
Right, so as you've mentioned, one of the biggest takeaways today was that the survey projected real GDP growth at anywhere between 6.5% to 7%. That's actually fairly conservative and with risks evenly balanced. The survey, in fact, stated that it is cognizant of the fact that market expectations are on the higher side. While the survey was broadly optimistic of Indian economic prospects going forward, the reason for the conservative estimate was geopolitical conflicts, higher commodity prices, chances of inflationary pressures, and a stalling in monetary policy easing because some of these geopolitical skirmishes that we have been seeing of late. Also, any corrections in elevated market valuations that may have ramifications for household finances as well as corporate valuations that might negatively impact growth prospects. The survey interestingly pointed that while IT jobs are picking up, they are unlikely to see any significant rise. On private capital formation, also the survey struck a cautious note, and it said that while private capex has been picking up the past 3 years, it might turn more cautious now because of fears of cheaper imports from countries that have excess capacity. Now, on price and inflation, the survey said that the outlook will be shaped by strengthening of price monitoring mechanisms as well as market intelligence. Also, we're going to be have to watch out for pulses and edible oils inflation, which has been a pain point and might continue to be one going forward given India's high dependence on imports on both of these commodities. On the key areas that the survey focuses on for stronger medium to long-term growth prospects, it's spoken about generative productive employment, the skill gap challenge that the economy needs to overcome, the criticality to tap the potential of the agricultural sector, the need to ease compliance requirements for MSMEs, and the need to manage India's green transition to balance that along with GDP growth.
All right, Pallavi, thank you very much for joining us and taking us through the key points. Well, the agriculture sector has huge potential for driving growth if incentives are channeled correctly. That's what the CEA Anantha Nageshwaran had to say at a press conference about the economic survey. Listen into what he told us.
Agriculture actually still carries a huge potential for driving growth if only we can make sure that the incentives are aligned and allied services in agriculture are also encouraged, and land consolidation also happens in a big way. Because more than 85% of the land is only about 2 hectares or less. And this has been coming down. The average land holding size has been coming down since the 1970s. And this is an action area for state governments.
All right, now the economic survey has entered the heated debate over what happens in the heated debate on futures and options. Here with me, of course, to delve deeper is my colleague Agam Vakil. Agam, how are people placing bets in the F&O sector ahead of the budget? Give us more details, please.
The Indian equity markets have seen an exponential growth when it comes to retail participation in the F&O segment over the last few years. And in fact, volumes have been further pushed since the introduction of weekly options expiries. And because of this, we have seen concerns coming in from 2 key places. One of them is the SEBI, where in fact the SEBI chairperson, Madhuri Puri Buch, who said that this has repercussions not just for individual retail investors, but also on an overall economic basis. Well, the economic survey, which was tabled today, has further echoed this sentiment, and in fact they also suggest that there needs to be a careful consideration given the higher retail participation in the F&O segment. And in fact they also suggest that derivatives trading holds the potential for outside gains, where they have also quoted that this caters to humans' gambling instincts and augment income if profitable. These considerations are likely driving active retail participations in driving the derivatives trading. However, globally, derivatives trading loses money for investors for the most part, and this has been the case in India as well, where in fact you see just about 1 profitable trader as compared to 9 others out of 10. Now, the question really is that what does the budget do in order to perhaps rein in on this surge in retail participation? On the whole, there are several measures that the government can take, and it's going to be a wait and watch on that one. But the fact that this issue has been raised by 2 key concerns, well, is the reason why it must be kept in mind, where we could potentially see some changes when it comes to the F&O segment. That's a wait and watch on that one.
Now, with the union budget set to be announced tomorrow, there are anticipated changes in policy for rural development, housing, agriculture, tax reforms, and more. We spoke to some corporate voices earlier today and asked them what they expect from the budget.
the engine for creating new jobs directly, indirectly, in organized and unorganized sector is that potential is immense in tourism and hospitality. And I think if one can find a way to give that kind of recognition or that kind of incentive, the demographic dividend of India will come into play very strongly.
One thing which we really expect is that if you look at the whole domestic manufacturing for electronics, where there has been a lot of policy initiatives and the government policy framework has been very, very supportive. So the first level of domestic manufacturing ecosystem has been robustly built in India. But if the India needs to go to the next level, then it has to increase the level of the domestic value addition, which can only happen through incentivization of the component ecosystem.
Our expectations from the budget is that the budget will continue to proactively invest and spend on infrastructure, which they've been doing, and focus on manufacturing, and the energy transition will continue. There will be some initiatives which we are seeing on the consumption side, which will be good overall for the economic growth of the country. That should spur steel consumption overall across sectors.
I think significantly also at the same time, while we're hoping that this budgetary allocation can move closer to the 4% of GDP that we have been asking for multiple years, we're hoping that this allocation is not just an allocation, but also is effectively deployed. And that is a tax incentive for healthcare infrastructure coming up in rural environments. We clearly see that the potential of healthcare is what IT did for India in 1990s. We've been saying this. It has that potential to give a boost to India, to also look at the global perspective of what India can contribute to healthcare. This is India's moment, or the moment of possibility, when we can take the potential, the data, the knowledge, the capability we have, and transform it into real live world-class solutions.
Well, time for a very short break, but on the other side, we discuss the Supreme Court's interim stay on Uttar Pradesh and Uttarakhand's directives, asking eateries on the Kavar Yatra route to display the names of their owners. Stay with us.
It's the most important union budget in many years, and all eyes will be on how the finance minister builds the road to Vixit Bharat.
We are working to make India a Vixit Bharat by 2047.
But not without a fair share of politics. Will there be a tilt towards populism? How will the finance minister balance between welfare, capex and fiscal discipline?
We get you the most comprehensive news and views on budget impact for investments, the taxpayer and the economy. Ride the bullish India wave only on NDTV Profit.
A powerful driver of India's growth. The Indian economy, development of all regions, technologies and innovations. Inflation is moderate. Investments are robust. More comprehensive GDP.
एक ही लक्ष्य, नेशन फर्स्ट, एक ही इरादा, 2047 विकसित भारत।
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health.
All right, ahead of the union budget, the economic survey becomes a very, very crucial document. It is that vision put forth by the chief economic advisor to the government that gives us a clue sometimes to what you can expect in the budget. Now, if I were looking for a clue in this year's economic survey, it would be the focus on Vixit Bharat. This is something that the Prime Minister also spoke about at the start of the budget session in Parliament. Can the economic survey give us a clear roadmap? What have been the big highlights? I'm talking about all of this and more with Prachi Mishra. She's former Chief Systemic Issues Division of the IMF. We're speaking on the economic survey and, of course, on the eve of the budget. Ms. Mishra, great to have you on NDTV Network. Thank you so much for speaking with us. Absolute pleasure. Let's start with one key point or key data point in the economic survey, and I'm keen to know your view on it, is the growth outlook, the GDP growth outlook that the survey puts across. The forecast is between 6.5 to 7%. Is it a conservative forecast, considering that a lot of global agencies have actually upped India's growth forecast to 7%? We have grown as high as 8% in the last quarterly numbers.
Thank you, Tamanna. A pleasure to be here. So I think let's put your question in a bit of perspective. I think the economic survey actually very rightfully highlights the impressive performance of the Indian economy despite a series of domestic and global shocks. So for FY24, actually real GDP growth, as you know, is estimated at a whopping 8.2%. And so this is a third successive year of strong growth. So if you look at 7% against this backdrop, it's definitely not conservative. And in fact, the survey correctly highlights that in the medium term, what you need is a sustained growth, and note note the emphasis on sustained growth. So if we can really sustain growth of 7% or more in the medium term, that can take us to achieving the goal of Vixit Bharat. So long story short, I think the forecast, the projection of 7% or between 6.5% to 7% is realistic. It's prudent, and don't forget that it's against the backdrop of a series of very strong growth years. Let me stop here.
Okay, so it is, it's not conservative. 7% definitely isn't. I was talking about the lower end of it, 6.5%, looking at the kind of growth we had. Also in the context of another statement that the Chief Economic Advisor made, talking about strong growth in private capex. I thought that was fairly interesting, Ms. Mishra, considering that this has been our bugbear, isn't it? That private capex is not coming back or not growing at the extent which is required. What are your thoughts on that? And if there's anything else which really stood out for you from this year's economic survey?
Right. I think actually the survey correctly points out that private GFCF as gross fixed capital formation has grown. We are seeing growth in private capital, the private sector capital formation. So I think for FY, if I'm looking at the figures correctly, for FY24, it was about 8 lakh, even above. It's actually close to 9 lakh, very close to 9 lakh crores. It's up from, if you compare, pre-COVID, it was about 5 lakh crore. So private sector capex is picking up, and a lot of high frequency indicators are pointing to a pickup in private sector capex. Real estate, as you know, real estate after series of shocks, the real estate sector and construction is picking up, and we are seeing private sector capex picking up. But many high frequency indicators of investment, even if you look at investment good imports, or you look at cement, several of these indicators are actually fairly above pre-pandemic levels. So I think the survey correctly points out that we are actually seeing a pickup. And again, I think what is important is to sustain the pickup. And so to go on to your other question, what really stuck to me from the survey is it really, while it highlights the resilience of the Indian economy, at the same time it does strike appropriate caution. And it highlights the importance of achieving sustained growth, sustaining the achievements so far, to take, to achieve our bigger goal of becoming a Vixit Bharat. And there, as you know, the survey lays out 6 priority areas. Which include, among other things, giving the right fillip to agriculture markets as well.
Yeah.
Let me stop here.
Yeah, so I started, in fact, this conversation talking about how the economic survey, and we often as journalists at least look for clues from the economic survey to what we could see in the budget. Would you say that the Vixit Bharat roadmap is definitely one of those clues? It's going to be a big focus, and the economic survey lays out with quite a bit of clarity how you get there.
It's hard to, guess, I think, what is going to come tomorrow. But I think if you ask me first and foremost, I think it clearly seems that the government will stick on its plan for fiscal consolidation, whether the number is going to be 5.1 or slightly below that. But it's fairly clear. I would expect the budget to stick to its path of fiscal consolidation. Highlight the asset. Another important thing which the survey highlights is the asset monetization program. So the asset monetization program actually is gaining quite a bit of traction. Some of the targets that were highlighted in FY22 budget are actually being fructified now. So I do expect a continuation of. How do you stick to a fiscal consolidation target when you're increasingly moving to capex spending? And as we know that public sector capex has played a big role. How do you sustain that? And I think one of the ways is through raising resources. And the asset monetization program has been one of the flagships. And I was very, encouraged to see that the survey highlighted that the program, the asset monetization program, going back to FY22 budget, because these things take time, is actually beginning to gain traction, and it's very close to what was targeted.
I want to just get your sense also on the PLI scheme, and I thought this was another highlight. Now we have been seeing that the PLI scheme has really worked, especially in some segments, your EMS, mobile, etc. IT hardware also will be one to watch out for. So that's what the economic survey also says. These schemes are gathering momentum as of May 2024, delivering handsomely. I want to understand from you, Prachi, do you think that there is room for more? Do we need to now expand PLI schemes to other sectors? Is that the way forward to achieve our goal of an impetus to manufacturing?
I think I think on the PLI scheme, let me also, it's very closely linked to the discussion of employment as well. And I thought, I think the survey, makes an important point about, the private sector to come forward and to join what the survey calls as the collective social responsibility. So I think so on the PLI schemes, I think again picking sectors. First of all, again, it was encouraging to see the survey that how the PLI scheme has worked in several aspects. I think a careful evaluation of what has worked and what has not, and putting the eggs respectively in those baskets, I think would be the way forward, in the sense that which are the sectors which the PLI can target, and which can also be consistent with repairing employment, more employment and good quality employment for an increasing, for a workforce as the labor force participation increases. So I think, long story short, I would say that again, encouraged to see, some of the evidence on PLI. Would be good to see more of it, and accordingly, targeting sectors which can boost manufacturing, but at the same time boost those sectors which also intensive in domestic employment, because as India is a labor abundant country, but increasingly we have seen capital to labor ratio, companies increasingly employing capital intensive techniques. So if the PLI scheme can actually be catered to industries which are more labor intensive, that can be like killing two birds with one stone. So basically, you can give a boost to manufacturing, at the same time, those manufacturing sectors which have the potential to create a high employment. But let me also add that when we think about PLI schemes, we mostly think about manufacturing. But in principle, you could also think about high value agriculture, and this is something which one of the 6 pillars which the survey highlighted was also exploiting the untapped potential in agriculture markets, and at some point high value added agriculture could also be one of the candidates for boosting the employment potential, of course, but also the export potential in agriculture.
Absolutely. So not just for semiconductors, also to help turning potatoes into potato chips, for example, could all be ways to use PLI schemes.
Absolutely. Food and beverage, textiles and food and beverage are the two largest, the two sectors which employ the highest, have the highest employment share in manufacturing, actually.
Just one last point, Ms. Mishra, and this is just because I found this so interesting and so important and wanted your view on it as someone who sees the economy so closely across the world, actually. So the economic survey talks about a lethal mix that could undermine public health and productivity and diminish India's economic potential, and marks out 4 factors: social media, screen time, sedentary habits and unhealthy food. Goes on to warn, quote unquote, the private sector that don't push this at the peril of the nation's future. I just thought that was very, very interesting. What is your take on that? That there is an actual economic and a negative economic impact of things like this?
Yeah, no, absolutely. So I think I really appreciate the fact that the survey has gone beyond standard bread and butter stuff, which is, just the economy, growth, inflation. If you actually look at the employment section, again, I'm focusing on this lot is in discussion. If you look at the employment section, I think it points out something very interesting, that employment is about dignity, self-worth, self-esteem and self-respect, and standing in the family and community, and not just about the income it brings. And that is why it is in the enlightened self-interest of the Indian corporate sector swimming in excess profits to take its responsibility to create jobs seriously. So I think this is another example of where, in addition to what you said, I think, how do you boost productivity? How do you, how do you create good jobs? I think you have to go to some of the basics. And actually there is research which has shown that, increasingly, Indian kids are getting into, snacking habits, and it has detrimental effect on their health and productivity. So again, I would like to explicitly acknowledge and, appreciate making the ambit of the survey a little bit wider beyond just the forecast for this year growth and inflation and maybe the current account. So absolutely, Tamanna, absolutely, I would say, looking a little bit beyond the narrow focus, I think is much appreciated, and it really adds flavor to the survey.
Completely. I found that an astonishingly insightful commentary coming in from the economic survey. Thank you so much, Ms. Mishra, for speaking with us. That was Prachi Mishra there on her take on the economic survey. And of course, we look forward to hearing you on the budget day after the announcements have made. That's all the time we have. We'll take a very short break, but stay tuned. A lot more coming up on the other side.
It's the most important union budget in many years, and all eyes will be on how the finance minister builds the road to Vixit Bharat.
We are working to make India a Vixit Bharat by 2047.
But not without a fair share of politics. Will there be a tilt towards populism? How will the finance minister balance between welfare, capex and fiscal discipline?
We get you the most comprehensive news and views on budget impact for investments, the taxpayer and the economy. Ride the bullish India wave only on NDTV Profit.
A powerful driver of India's growth. The Indian economy, development of all regions, technologies and innovations. Inflation is moderate. Investments are robust. More comprehensive GDP.
एक ही लक्ष्य, नेशन फर्स्ट, एक ही इरादा, 2047 विकसित भारत।
and the whole day passes like a blur. The news just...
This is NDTV, and you're watching NDTV Profit. In association with Samman Capital.
Hi, thanks so much for joining in. You're watching Budget Countdown. My name is Alex Matthew and this is NDTV Profit. We're just days away from the presentation of the Union Budget 2024 and we've been discussing what could be taken up by Finance Minister Nirmala Sitharaman. Will the thrust on infrastructure and defense continue for one? And from the perspective of the individual taxpayer, will there be any relief provided? But what about the investor? The call to rationalize capital gains tax has been repeated consistently for several years now, and in 2024 there are several reasons why this should be considered. We're going to talk about all of those reasons with our guest today. We've got Pranav Saita, tax partner at EY, joining me in studio. Pranav, thanks so much for taking the time.
Thank you.
To set the context, I want to actually go to my colleague first. We've got Mahima Vachrajani joining us to talk about the treatment of various asset classes and the fact that they are in fact treated very differently when it comes to capital gains tax. Mahima, what can you tell us?
Right, Alex, so I'll straight away start with equities first, where for equities, the short-term capital gain is, if it's short-term capital gain, if it's less than 1 year and more than that is long-term capital gain, the short-term capital gain rate is 15% and LTCG is at 10%. Now, of course, LTCG is exempt up to 1 lakh rupees. For real estate, similarly, short-term capital gain is below 2 years and more than 2 years is long-term capital gain. For in this case, short-term capital gain is taxed at slab rate and LTCG rate is 20% plus indexation. In terms of gold, well, for gold, short-term capital gains is considered when it's less than 3 years and more than 3 years is, of course, long-term capital gain. Similar for gold as well, short-term capital gains is taxed at slab rate, and for long-term capital gain, it's 20% with indexation. Now, in terms of fixed income mutual funds, all gains are taxed at the slab rate. For listed corporate bonds and government bonds, short-term capital gain is considered if it's less than 1 year and more than 1 year is considered as long-term. And in terms of short-term capital gain, it's taxed at slab rates and long-term is at 10% and this is without indexation. And lastly, unlisted debt securities, for this, short-term capital gains is considered when the securities held for less than 3 years, and long-term capital gain when the securities are held for more than 3 years. And for this as well, short-term capital gain is taxed at slab rate and LTCG is at 20% with indexation. So these are the various ways where different asset classes are taxed.
Absolutely. Thanks so much, Mahima, for getting us those details. Now, you've probably experienced this yourself and you've probably had conversations about this. Tax can be a little complicated. But Pranav, is this more complicated than it should be?
Oh, I think so, yes. There's no doubt about it. Even I would have to go back to the book and refer what the tax treatment in certain situations will be, because of the fact that over a period of time, and very legitimately, various things have evolved with the result that it's become quite complex. Depending on the nature of the asset, whether it is financial instruments or otherwise, within financial instruments, what is exactly the nature of the asset? What is the period of holding? Has the transaction been on market or off market? Is it STT paid or not paid? The period of holding, whether it should be 1 year, 2 years, 3 years. And it's gotten quite complex over a period of time just because of the way in which it has evolved. And then again, within the nature of the asset, apart from the status of the SSE, resident, non-resident and so on, whether the nature of the asset, if it is REIT InvIT units, there's certain things for long-term, short-term, 3 years. For other listed securities, it's something else. So it's just getting a little too complicated and people tend to probably go back every time and figure out what exactly will be the tax treatment. That's not a hallmark of a great tax regime. A great tax regime normally should be simple so that the taxpayer pretty much knows very easily what is his likely tax liability in certain situations. So I think there is a need, a real need, to simplify and rationalize the capital gains tax regime rather than have too many categories of assets and too many different treatments. It would be good to have very few categories and very clear logic and rationale for those 3 buckets or 2 or 3 buckets, and the tax rates, the period of holdings, and so on being very clearly clarified for each.
We will talk about what an ideal scenario would look at, Pranav, but before we do, I would like to talk about the elephant in the room, if you can call it that, because every time there is buzz about an increase in the capital gains tax on equity, then equity markets react. If at all there is an announcement in the budget pertaining to the increase or the decrease in long-term capital gains tax, then there is a massive reaction. The last time there was a change, it was 2018, but I want to go back all the way to 2004, because this is when long-term capital gains tax was removed. STT, Securities Transaction Tax, was introduced. The interpretation for those that were not really tracking the market or taxation at the time is that one was introduced in lieu of the other. Is that the right interpretation?
Oh, absolutely. And that was very clearly brought out in the finance minister's speech in that year. I think it was Mr. Chidambaram, who introduced the Securities Transaction Tax just to simplify the tax regime and make the collection of taxes also very simple, and for taxpayers not to worry about the tax while deciding whether they are buying, selling, the point of time of buying and selling, and so on. So essentially it was introduced as a simplification measure and as a substitution of the listed long-term listed securities capital gains tax. And in that year itself, I think the collections were pretty robust. I think it was less than 12,000 crores. But I mean, in fact, 12,000 crores was about in 17-18, if I recall right. And from that itself, in the last 6-7 years, the collections have tripled. In 2004, it was pretty nominal. In 17, I think it was less than 12,000 crores. Now it's expected to be, as per the budget estimates for this year's interim budget, it's expected to be more than 36,000 crores. And if the actual numbers are to be looked at, probably it's going to bust those numbers.
Because we have data from April to June this year, and incidentally, it's a 128% increase on a year-on-year basis. We're talking about 16,000 plus crore rupees just in those 3 months, Pranav.
Correct. So I have no doubts that 36,000 number will be busted in all probability, unless the budget upsets the capital market, so to say, which is unlikely, I think.
So the reason why...
And last year it was 32,000 crores for the full year revised estimate for 23-24. And in this year, 3 months, you are saying it's...
Yeah, so this is a factor of the number of investors and the volume of transactions, ultimately, right?
Absolutely.
And with the kind of increase in the participation in the equity markets, you've seen this value go up as well. Now, talk to me about, say, it's 20 years of STT. It's done well, to say the very least, and it will do well. But the reintroduction of long-term capital gains, people were not too happy about that. Of course, there was grandfathering and all of that. But then now there's there was buzz in the run-up to the budget that it could be raised again. Is there a case for that?
Oh, I don't think it is very likely. Of course, one can never rule out anything. I don't think it is very likely, because I think even the government realizes that this was an addition to the STT in any case. Second, I think there is a realization that Indian investments into productive assets like securities and shares and financial instruments is something that is really charging up the economy. And to an extent, even giving a fillip to entrepreneurship. So I personally do not think that this 10% is likely to go up. But yes, indeed, there is a buzz, or there is fear, let's put it that way, that it could go up under the guise of simplification and rationalization of the capital gains tax regime. Well, I do think, if at all, one hopes not, but one cannot be sure, if at all, probably the short-term capital gains tax could go up from 15%. But I do not anticipate the long-term capital gains tax going up from 10%, because of the various factors. One, that we are talking of investments in productive assets. It is the domestic investor who has really ensured that capital is available in what was otherwise always regarded as a capital-starved country. So while foreign investments have been really very tempered, very moderate, so to say, if I might say so at all, it is the domestic investors who've kept the capital markets, the flow of capital into business, really sustained. So I don't expect the long-term capital gains tax to go up in this budget. Short-term capital gains tax could be, probably, because of the fact that only 1 year is long-term, and there is a feeling that one wants to probably temper the euphoric mood or the stampede in capital markets where people want to trade and do even F&O kind of deals and so on. So that tempering probably and getting a little more longer term mindset might be the philosophy, and at the same time 15% looks a real good rate. Of course, with STT in place, even that can be probably debated, but I'm just telling you what probably at worst could happen is my feel.
It's the most important union budget in many years, and all eyes will be on how the finance minister builds the road to Vixit Bharat.
We are working to make India a Vixit Bharat by 2047.
But not without a fair share of politics. Will there be a tilt towards populism? How will the finance minister balance between welfare, capex and fiscal discipline?
We get you the most comprehensive news and views on budget impact for investments, the taxpayer and the economy. Ride the bullish India wave only on NDTV Profit.
A powerful driver of India's growth. The Indian economy, development of all regions, technologies and innovations. Inflation is moderate.
Based on the share of India and global derivative trade, it wouldn't be an exaggeration to call India a trader's market. But having said that, let's talk about how what you said could pan out. A rationalization of the treatment of capital gains could result in an increase in the tax ultimately. And my without even changing the rates, because if you were to, for example, say that all capital gains will be considered long term if it breaches 2 years or if it breaches 3 years, automatically people selling at less than 2 years will be taxed at 15%. So you're ultimately increasing the tax collection.
Undoubtedly, that also is something that cannot be ruled out. So one is the tax rate, second is the period of holding. One cannot rule that out, and if we look at the international scenario, there are different countries having very different models.
How do they work?
Yeah. So for example, there are some countries who don't distinguish between long term and short term at all, like Canada, UK and so on. Denmark for that matter, Indonesia. So they don't differentiate between the two. There are some like US, Australia, etc., which have the 1 year rule. Some countries like France have the 2 year rule for the cutoff between long term and short term. So there are very different models. But I think in India, this 1 year model has worked quite well for a long time. And I would feel this government has focused very rightly on maintaining some form of stability in the tax law, which is a great virtue, because investors, whether in India or abroad, are looking for predictability, are looking for stability, are looking for some form of certainty when they are taking longer term decisions. So I do not think this government is normally induced with the desire to tinker too much. So I'm not anticipating that, but yes, that's another way of probably saying that if you extend the period from 12 months to 24 months, you automatically within that 1 year, 12 to 24 months, whoever sells pays 15 instead of 10% if the rates remain the same. Certainly a possibility, I wouldn't rule it out, but I hope that's not something that they are looking at.
Okay, so it's not the ideal solution.
I do not think so.
Okay, so before we get into the ideal solution, I also want to talk about this interesting announcement that came, if I'm not mistaken, correct me if I'm wrong, last year, where you're talking about fixed income mutual funds, where you invest in listed corporate bonds, which now it's going to be easier to do because the face value is going to be lower. And the treatment of capital gains there is that if it's less than 3 years, it's going to be short-term capital gains. If it's more than 3 years, you will be taxed at 20% with indexation benefits. The result of which is that your tax incidence is very low, comparatively. Right. But if you invest in the same asset through a mutual fund, everything is considered short-term capital gains and you are taxed at slab rate. Isn't there a bit of an issue here?
So the long-term benefit might still be available, but the indexation is not available because of the amendment that we got last year. And I do feel it's not the ideal thing, because for the simple reason that when it comes to a capital gain, and in an economy like India, to the extent there is no real gain and the gain is nothing but inflation, then to tax that is something that doesn't sound very fair. And therefore, I would feel that when they do rationalize, and I'm hoping that when they do rationalize the capital gains tax regime, one of the things that they would do is not tax just inflation, but tax real income, which is income beyond the indexation or the inflation rate for that period. Right now, I am not too sure whether this budget will restore that particular thing, but whenever they look at a larger revamp and simplification, rationalization of the capital gains tax regime, our ask has always been through various forums that you must have indexation in place, because that's something that ensures that you are not merely taxing inflation. Inflation is something that breaks the back of the middle class anyways, and on top of, or every person really. And on top of that, if it is taxed without any real income or gain being earned by an investor, then that's something which really adds to the agony of the inflation itself. So I would feel that's something that is very important to ensure. And if I look at international investors, they really look at